Welcome. During this video, we will discuss the key analysis task, metrics and performance indicators, so you have a good understanding of how to ensure your business case objectives are measurable. The definition of metrics and key performance indicators is to measure the performance of solutions, solution components, and other matters of interest to stakeholders. A metric is a quantifiable level of an indicator that an organization uses to measure progress. An indicator identifies a specific numerical measurement that represents the degree of progress towards achieving a goal, objective, output, activity, or further input. A key performance indicator, or KPI, is one that measures progress towards a strategic goal or objective. Reporting is the process of informing stakeholders of metrics or indicators in specified formats and at specified intervals. Remember that even after your business case has been approved and the solution implemented, there will be activity to measure the success of the solution by making sure the business case objectives have been achieved. This is why it is important for you to pay close attention to the concepts of metrics and key performance indicators when you define your business case's objectives. Metrics and reporting are key components of monitoring and evaluation. Monitoring is a continuous process of data collection used to determine how well a solution has been implemented as compared to the expected results. Evaluation is the systematic and objective assessment of a solution both to determine its status and effectiveness in meeting objectives over time and to identify ways to improve the solution to better meet objectives. The top priorities of a monitoring and evaluation system are the intended goals and effects of a solution, as well as inputs, activities, and outputs. Let us now describe the term indicator. An indicator displays the result of analyzing one or more specific measures for addressing a concern about a need, value, output, activity, or input in a table or graphical form. Each concern requires at least one indicator to measure it properly, but some may require several. A good indicator has 6 characteristics: clear, precise and unambiguous, relevant, appropriate to the concern, economical, available at reasonable cost, adequate, provides a sufficient basis on which to assess performance, quantifiable, can be independently validated, trustworthy and credible based on evidence and research. Not all factors can be measured directly. Proxies can be used when data for direct indicators is not available or when it is not feasible to collect at regular intervals. For example, in the absence of a survey of client satisfaction, an organization might use the proportion of all contracts renewed as an indicator. When establishing an indicator, business analysts will consider its source, method of collection, collector, and the cost, frequency, and difficulty of collection. Now let us consider the term metric. Metrics are quantifiable levels of indicators that are measured at a specific point in time. A target metric is the objective to be reached within a specified period. In setting a metric for an indicator, it is important to have a clear understanding of the baseline starting point, resources that can be devoted to improving the factors covered by the indicator, and political concerns. A metric can be a specific point, a threshold, or a range. A range can be useful if the indicator is new. Depending on the need, the scope of time to reach the target metric can be multi-year, annual, quarterly, or even more frequent. In summary, we have discussed the importance of defining your objectives with clear indicators and metrics. This lesson provided you with a good overview of what the term indicator and metric means and will be invaluable when you define your objectives following the SMART format. I look forward to discussing the next topic with you during the next video.